Hi, I'm Jimmy. In this video, we are looking at the craziness that is happening in the stock market thanks to the massive rollout of tariffs. So as we can see, this is a 3-month chart and the S&P 500 is down about 15%. If we were to jump over and look at the Dow Jones Industrial Average, which is made up of less companies, it's about 30 companies in the Dow, well, this one's down about 10%. And then if we jump over to the NASDAQ, these are more tech-related stocks. This one's down more than 20%. So the market is getting absolutely croaked since the rollout of these new tariffs. Now, I've actually done some videos in the past on tariffs. I'll leave links in the description below if you're curious to learn about what they are and how they could impact things. But basically, the long and the short of it is that if a tariff is imposed on a foreign country, so let's say the US imposes tariffs on China. Well, if China makes iPhones and they ship the iPhone from China to America, well, Apple, in this case, if they're buying the iPhones from China, Apple has to pay, let's say, a 20% tariff, a 30% tariff, whatever that is. Well, now, since America and companies in general tend to be very profits driven, well, Apple, that 20% increase, 30% increase, whatever it ends up being for the cost of that higher priced iPhone, since they have to pay that 20% tax, since Apple has to pay that 20% tax to the government, they're likely to just increase the prices of those phones to their customers to make up for the fact that their cost is frankly 20% higher now. Now, one of the fears that could develop out of this is the potential of retaliatory tariffs, or in theory, if America is becoming more isolated from the rest of the world, because apparently we're doing tariffs on the entire world, but if America becomes a more isolated country, well, this hurts. There will oftentimes be retaliations from those countries here. If you're not going to buy our products, we're not going to buy your products. But that might have a bigger impact than a lot of people realize. So when we look at some of the bigger companies in the S&P 500, some of America's biggest companies, well, a lot of the revenue that these guys generate come from overseas. Just to illustrate, Apple, one of the biggest companies in the world, we could see less than half of their revenue is generated in the United States. So if the retaliation of China, let's say, well, you're not going to buy our products, well, then we're not going to buy your products. It's really that simple. And that could end up being a problem. You got a company like Microsoft. It's 50-50 that 50% is in the US, 51% is in the US. The other 49% is outside of it. This is a very global economy. We're looking at a company like Amazon. Amazon, a lot of US citizens might think of Amazon as a very US company, and it is. But as we could see, two-thirds of revenue is generated in North America. But that's not just the United States. A lot of revenue is generated overseas. Even a company like NVIDIA, one of the biggest growing tech companies out there, again, only half of their revenue is generated in the United States. So the idea of retaliations, one of the reasons the stock market has pulled back as dramatically as it has, is that we don't really know the impact of how all this is going to play out. But frankly, none of it is looking all that great. To illustrate that, as we explained a moment ago, if a company were to buy goods overseas where there's a tariff on that country, those goods get shipped here. The US company pays that tax. The tariff is a tax. They pay that tax to the government. Well, they then have to increase prices. As we all know, as I'm sure most of us are aware, increased prices is another word for inflation. Inflation, we know that after COVID and after everything that happened with COVID, inflation went higher. That was a real pain. You know, groceries got more expensive, cars get more expensive, everything gets more expensive. That can be a real pain. Well, the way you combat inflation, the way the Federal Reserve, the Treasury, with the way the government combats inflation is one of the ways is to increase interest rates. Well, they did that. Inflation pulled back some. And then they were like, okay, let's spur things up. By the way, if you increase interest rates, that is a way to slow the economy. Slowing the economy will also slow inflation. Dropping interest rates will increase the rate of it will speed up the economy. It will make the economy better. But if we're manually forcing inflation upon us by basically charging American companies a higher tax rate, if we do that, and this isn't even a higher tax rate that just goes to the government, this is on top of what they're already paying the government. This is a fee that directly makes their products higher. This isn't cutting into their profitability. This is cutting directly into the cost of the product, which is the real problem. This isn't Apple getting charged a higher tax. This is, we're going to make phones 20% or whatever the percentage is on their phone, whatever that ends up being. We're going to make that phone 20% more expensive. So the users, the end user, the buyer of the iPhone or the Samsung phone, whatever it is going to pay more for that product. Well, how will the government have to react to that if inflation goes up again? Well, the way to do it is to increase interest rates, certainly not lower interest rates. In the meantime, we're not really sure what the rest of the world is going to do. Are they going to retaliate? How are they going to handle the situation that we put them in by imposing all of these tariffs? Now, I think this brings us to an important point is, what is the point of the tariffs? Now, one of the key points to consider here is that, in theory, if we impose tariffs, well, that urges, let's say, companies, let's say Apple's, take an Apple, their iPhones, we're saying essentially to Apple, by imposing the tariff on where they make the phone, we're saying, don't make them over there, make them here in the US. One of the problems that we have is that, first of all, with the amount of volatility that's happening, with the amount of kind of the political push and pull on both sides of the aisle, because of that political stance, well, it would take Apple a ton of time and a ton of money, billions and billions of dollars to bring that manufacturing back to the United States. And it would still cost a ton more to manufacture them here than in China. That's why they manufacture them in China. But it would also take years. It would take years to put that in place. You can't it's not like they're just going to roll it out in a month. It would take years to actually build the factory and put it up and get it up and running and to maximum production and all of that. Point is that if you're Apple and you know this is a political thing and not necessarily what's best for the overall economy, well, what do you do? What's your best move? Do you bring manufacturing back, or do you just wait for a new political office, somebody else to get into office in a few years, and then hopefully things change? Or maybe the current administration decides to change their mind or pull back tariffs or perhaps make an exception or something like that. There's so many moving parts, and I think it's the uncertainty that makes this the biggest problem. That brings us to the question of, what do we as investors do? So me, on a personal basis, I actually recently launched a new portfolio, high quality portfolio, and that could not be coming at a better time given what is happening with the market. We saw how much the stock market is pulling back, so finding good opportunities right now is ideal. But I think because there's so much uncertainty, many times it makes sense to stick with high quality companies that have higher margins. Buffett says, go after companies that have a high moat, companies that perhaps it's not that easy for other companies to compete with them. If we can focus our research on higher margin companies, well, that gives us a little more wiggle room. So if costs do go up, let's say a company has 20% profit margins and costs go up by 10 or 20%, well, they have some wiggle room there. So in theory, that would hurt them less, or at least their solvency, whether or not they would stay in business, wouldn't be questioned. So I think focusing on companies that have strong balance sheet. If interest rates have been projected to decline, this might pause things. This new move that just happened for tariffs might cause the Fed to hesitate with whether or not decreasing interest rates go up should happen. And if anything, in time as inflation, by the way, inflation will take a while to see this inflation. This isn't something that, hey, oh my God, 2 weeks later, everything's good. It's going to take a while to play itself out. So in the next few quarters, the next year, if they see, well, inflation is going up because of these tariffs, perhaps they have to increase interest rates. So we want companies that are high quality companies, have good margins, have strong balance sheets. Now, over here, this is a list of the S&P 500 companies. I had created this list this is adjusted net income profit margins. So what's their bottom line look like? What percentage of their bottom line from the past 12 months, what's the percentage of their bottom line is remaining as profit? In theory, they could use that to, pay out dividends or buy back stock, things like that. This is those profit margins. You can pause at any point if you're looking for any companies. Now, I recently did a video on Microsoft, and I am currently buying Microsoft because, again, Microsoft has excellent growth, strong profit margins, very strong balance sheet. I'm currently researching Adobe in our Investors Grow community. We do these research live streams. I recently did a live stream on Adobe, so I'm going to be releasing a video on Adobe, and Adobe looks like one of those strong companies. Spoiler alert for the video about to come out, it looks really impressive. This could be a good one to add. And since we saw that NASDAQ companies are down a ton right now, there might be some real opportunities over there. So now is not the time to panic. The market tumbling is not the time to panic. If you're not sure if, maybe the stock market could keep falling, maybe just dip your toe in the water. You find some good high quality companies that you've done the research on. Maybe just buy a small position, maybe a half position, whatever it is for you. And then if the stock keeps falling, you can average down. You can always buy more later. And you could end up with a good price, because if you're looking out as a long-term investor, I'm talking 5, 10, 20 years out, well, in time, this will shake itself out. So hopefully, if you guys have any good ideas for companies that we should research, please let me know in the comments below. If you want to sign up to get access to the Investors Grow website, where we try to make it quick and easy to research companies, value companies, do research like we would do on, for Adobe or Microsoft, I will leave a link right here, link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.